All right, everyone, we're going to go ahead and get started. I'm Emily with Broker Online Exchange, and I'd like to welcome everyone to our July Energy Market Intelligence webinar. I'd like to start off again with a quick poll just to get a better feel for who our audience is today. So take a look at the question and let us know what your role is in the energy industry. All right, thanks everyone. I'm going to go ahead now and turn it over to our energy market analysts, Elliot Chorn and Joe Prozac.
Hi everyone, Elliot Chorn, Truelight Energy. I'm joined today by Joe Prozac, who is on our wholesale desk here at Truelight Energy. Excited to talk to you about what's been going on in the market, what we see going on in the market over the next few weeks, months, out through towards the end of the year. As always, highly encourage you to submit any questions that you might have via the GoToWebinar application. We will try to address those as they come in, as we get to them at the end of the presentation. With that, I'll hand things over to Joe to kind of get us started talking about what's going on in the wholesale market, and we'll go from there.
Well, thanks, Elliot. What we're looking at in front of us is the near-month natural gas future prices. Kind of the same chart that we show you really every month on the call, no major movements, and that's kind of set up the frame of how we're viewing the market for the next year or so on the gas side. Not a lot of movement. If anything, things are looking on the lower side, on the bearish side, like around $3 for next winter. So we're going to talk a little bit about that later, and we highlighted that last week for the way gas and the winter prices are looking for 2019. But taking it a little bit back to the wholesale side, gas typically doesn't play a big role in the summer, and in fact, summer is really driven by the air conditioning and cooling load, and we're seeing a lot of that down in the southern parts of the country, out in the western parts of the country, where we just had a huge heat wave coming through Texas, and another heat wave building up in California, which is going to be there for the next 3 to 5 days or so. As the way that the ERCOT market has responded, there's a lot of hype on if we would get into those $9,000 ORDC prices, and we didn't ultimately end up seeing that, but we ended up seeing some higher day-ahead fears around the $2,000 level. Nothing quite really showed up on the real-time side. But that's kind of what we've been seeing on the wholesale side.
Yeah. So on this chart that we're looking at, this is really just talking about what next month's gas price is going to be on the futures market. Pretty steady. You can see a couple of spikes kind of in that winter time period. But really, there's been no large amounts of volatility. If you've been listening in on these calls for the past couple months, we're probably starting to sound a little bit like a broken record. There's plenty of supply for natural gas, and demand isn't really changing. That flows through into kind of what's happening in the wholesale power markets as well. As we look at the next slide, these show a little bit more of the actual spot market prices. So what you could buy the gas off of the pipeline at that point in time. So no longer talking about the futures market, but more on the spot market. Again, you can see those spikes. They're very localized in winter periods. We had a big one this last winter, but lately, gas market's pretty stable. You can see that it seems like there is a consensus between buyers and sellers of natural gas that the price of natural gas should be about $3. It's pretty clear when you look at this chart, you look at futures charts, that the gas prices are really going to be kind of range bound at this point. somewhere between $2.70 and probably $3.30. And that's probably a pretty big range. We've really seen things trapped in kind of the 290 range recently, and really don't have any compelling reason to think that that's not going to continue off into the future. There's plenty of gas being produced. There's plenty of gas in uncompleted wells, so wells that have been drilled but are not connected into the pipeline infrastructure yet aren't flowing gas out. So even if demand were to jump and you'd see prices respond to that, there's plenty of gas to then meet that demand. So again, low volatility in gas markets outside of those winter time periods. That was kind of what Joe was saying. It's that winter time that you're really going to see gas prices start to react, and that's just going to be a short-term supply demand issue. Joe and I are up here in Boston, and when it's the middle of the winter, and you're not getting above 20 degrees at any point in the day. A lot of demand for heating, and when there is both the residential commercial heating demand and the power demand are competing for that, for a short-term limited gas supply. You can see some of these price spikes. Looking to the next slide, talking a little bit about what's going on in the supply demand. Pretty standard picture here of what we expect to see. Consumption in the wintertime higher than in the summertime for exactly what I just described. Both power and heating demands in the winter. We start to in the summertime see more of just a power burn driving our gas demand. With that being said, there's some interesting things going on with gas storage right now. We are at a low point for where we've been over the past few years for natural gas storage. It's been interesting to see because 3-4 years ago, Joe, maybe more, we'd see a low storage number, and you'd see gas markets really react to that. But we're not seeing that now. There are predictions at this point that we're going to exit injection season, so kind of hit that October 1st date, and we will be below the 5-year range of storage. So there will be less gas in storage than there has been over the last 5 years entering into heating season. We would expect, thinking back historically, that would drive a lot of price volatility both in gas markets and then that flowing into the power markets, but it's not. And again, not to sound like a broken record, but it's really just the high availability of supply. Natural gas fracking really changed that game, and that's outside of some sort of major regulatory change where Pennsylvania bans fracking. Hard to see how that's going to change. I think now we can move on to the next slide and talk a little bit about what the weather picture is, and then how that's dictating some short-term power price movements.
Yeah, so looking at the next 3-month forecast, which is what we have in front of us from the NOAA.
Sorry, this is the 8-15, I think.
It is 8-14. I thought it was 3 months. So yeah, this is the next 1 to 2 weeks. This is what we're looking at for temperature anomalies. Pretty much below normal, kind of in the heart of the country in the Midwest, reaching out to a little bit of the western part of the country. Out in the far west, there's a nice concentration of above normal heat, which is, as we were talking about earlier, with that strong heat wave that's going to be in California. It's already there right now. We're looking at potentially some record temperatures along the coast in those major load centers. But we're kind of looking forward towards the east. We're kind of stuck in this weird pattern, which we've seen for the last week or so, maybe even extending back towards like early July, where it's below normal temperatures with a big low pressure system sitting in the middle of that Midwest period, and that brings a lot of relatively low temperatures for this time of year towards the East Coast, but also a lot of humidity and a lot of moisture with that as well. So the main impact we've seen that extended onto the wholesale markets has been a fairly bearish impact on the demand. So if you're looking at the PJM load curves, or even up to New York or in New England as well, when rain kicks in the afternoon, as the humidity builds up and finally turns into rain in the afternoon, after all the energy kind of all that precipitation begins to unfold, the demand curve takes a hit, and you begin to see those real-time prices crash. So that's why we haven't been seeing too much real-time price volatility it really throughout July, and looks like July is going to end this way, and at least the first portion of August is going to begin this way, with PJM, New York, and New England continuing to see quiet markets. Now, the big elephant in the room, of course, is ERCOT, as we were talking a little bit about earlier. As now on the tail end of its major heat wave, record temperatures in most of the major cities in Texas, ERCOT largely got through that heat wave without major price volatility on the real-time side. The day-aheads, however, is where you saw a lot of price volatility, with some clears in certain hours getting up to $2,000. The market clearly expected real-time prices getting up into the $9,000 range, but confluence of factors prevented that from happening in real time. And what you had were typically probably the biggest impact was demand, where ERCOT continually, almost religiously, over forecasted demand, missing by 1 to 2 gigawatts even on some days, which is a large percentage of overall load. And when you have demand missing by that much and load coming in a lot lower than what ERCOT expected, they're able to run a lot more generation and effectively suppress the real-time prices. Also, they were able to run some more resources through the ancillaries market, which sounds kind of complex, but what it really means is that they're running these generators through the ancillary market, giving them ancillary payments, but not running them through the energy market. So you end up getting a similar pool of generation resources online, but ultimately you don't have the real-time prices responding and increasing in order to get those generation resources online, because ERCOT can bring them online for purpose of reliability and other various issues tied to those ancillary markets.
It's interesting. I would say over the past month since the last time we talked, we've seen two major heat waves hit two of the largest markets, maybe even three of the largest markets. Three of the four deregulated ISOs. So as Joe was talking about this past week in ERCOT, if we look back to kind of the week of July 4th, we saw that big East Coast heat wave. And that honestly, it extended all the way up here into New England. So you saw all of PJM, New York, New England get battered by excessive heat, and not just for one hot day, but for a number of hot days over and over and over. Typically, we expect when we see those kind of things, and the market expects that we're going to see very high real-time prices. So they're going to have to run the most expensive generation to meet demand. And during both of those heat waves, so hitting all four of our major ISOs, we really didn't see any of that real-time volatility that we expected to see, or that we have historically been trained to see. Joe and I were talking, kind of getting ready for this call about what's driving that, and I think I think we came up with maybe like three kind of factors, and I think Joe's touched on a couple of them. One is the over forecasting of demand, and this one's actually kind of tied to another one. So the over forecasting of demand, the ISOs every day during the day ahead dispatch are trying to figure out how much generation they're going to need to dispatch and getting those people lined up in the day ahead market. And their forecasts have been off. And the question is why? Are they just bad at this? Well, there's a bunch of PhDs sitting in a room trying to figure out how to be really good at this. So no, it would be kind of our guess on that. And kind of what we've come to the conclusion of, and this has been a conversation that we've heard rumbling around a lot in the ISOs, is behind the meter generation. So behind the meter generation is going to be your like solar on the rooftop. If you have like standby generation that you can run, that oftentimes the ISOs don't have visibility into. So behind the meter generation, instead of acting like a natural gas power plant would, where the ISO is going to call them up and say, hey, make power to make sure the system stays up, it actually acts as a load suppressant. So from the ISO's point of view, they just see load underperforming. When we say load underperforming, they make a prediction, and it does not reach that prediction. It comes in much lower. And so Joe and I have been bouncing around the idea and trying to dig around and see if we can find some data to talk about why, or to support our hypothesis that all this behind the meter generation, your solar city putting solar on the rooftop, these carports that you see popping up with solar panels on them, if that's impacting how the real-time market is behaving, and then what does that mean from a consumer point of view? How does that impact them? Because we saw the day-ahead market get bid up really high. We saw hours clearing at $1,500–$1,600, which is $1,500–$1,600 a megawatt hour, which is an incredibly high price. But then the real-time market settling in at what, $80 during some of those same hours, right? So what does that mean? And again, this is a hypothesis. We're doing the analysis on our end to try to figure it out. But it really kind of leads me to believe that in the near term, that the real-time market might not have the volatility that it has had historically, and therefore a real-time product for an end user, so a customer on a real-time index product, could be an interesting idea. There could be some advantages for your end user customers to exploring what a real-time market product might look like. Now, being completely exposed to the real-time market could be pretty scary. So depending on the customer size, there are suppliers that will offer what we call like a block and index type product, where they have exposure to the real-time market, but then they're able to buy blocks of power at attractive prices to hedge some of that risk. So those are two of the three, which is the over forecasting and then the behind the meter generation. And I'm blanking now on what the third idea of why
ancillaries.
Oh, right, the ancillary market. So as Joe was talking about, the ISOs can procure generation, so the power generator is going to turn on through the energy market, which is what we talk about like in LMP markets and the actual cost of energy, or they can do the same thing through the ancillary market. In some of those time periods where in the real time we saw, ERCOT prices in the $40–$50 range, so yeah, summer, but nothing crazy. We were seeing ancillary prices up in the $2,000 range. So it's pretty clear to us that some of those costs are getting pushed off to the ancillary market. From your point of view, what that really how that impacts you and your customers is, one, keep an eye out for any pass-through charges coming along. Suppliers sometimes will use that and pass through a cost that it's an unexpected cost, and so they'll pass that through. It'll also probably start to impact some ancillary curves, so you might start to see some prices start to push up a little bit. Granted, ancillaries are a small part of the overall cost stack, but you might see prices start to creep up a little bit on that. But it is something worth talking to your customers about. That there has been a little bit of volatility on those, and it might be something to think about how your customers are hedged on that. As we start to look out into the future on the next slide, into the kind of the long-term weather forecast, red means hot, and it's pretty simple. So this chart makes it pretty clear that NOAA, so the National Oceanographic and Atmospheric Administration, is predicting that the rest of the summer and even out into the fall is going to be above normal temperatures, particularly the southwest, west, down into Texas, and then New England, New York, and upper PJM. So, I'll let Joe talk a little bit about how that could impact prices and how prices look over the next 2 to 3 months.
Yeah, so this is kind of a pattern that we've seen come in the last 2 to 3 falls. Is what happens is that we get through the summer, it's relatively quiet, especially in the eastern markets. And I'm talking more about PJM, New York, New England. Not a lot of volatility due to those reasons that we were just discussing, but once we hit the fall period, a lot of those items are off the table, and specifically on the generation side, we're looking at more generators coming out of the stack and declaring maintenance outages. A lot of transmission lines or transformers, just transmission elements, also going on outage for maintenance, and all of a sudden the grid that was once very healthy and could serve a high level of system load during the summer, it's now a different grid. It has lower capacity, can transfer power in only in limited quantities across large distances now, and even though demand is lower, the impact of less generation and less transmission elements in the system can outweigh the impact of the lower demand, and we can actually see an uptick in volatility. So you could call it the Indian summer, but what we've seen in the last 2 Septembers, more specifically, has been a good uptick in volatility in the real time in the eastern markets, as you have this prolonged heat that kind of lasts into late September, even early October. So that's what we're kind of looking out for this year, is with this long-term weather projection from NOAA, looking at the above normal temperatures on the East Coast and all the way up into New York and New England, kind of that upper northwest corner of PJM as well. We are looking at a little bit of a risk for that volatility to creep back in once you have these generators coming on outage. And that's kind of what we're looking at for on the eastern side. Kind of looking out on the west, you still have that high concentration of above normal temperatures, kind of getting out towards California. What remains to be seen where exactly that's positioning, but it does look like Texas is going to be kind of not getting that high above normal, but it's still decently above normal. So we are looking at that heat carrying over into the fall, potential for some volatility as that generation slips out of the stack. Unlike the eastern markets, ERCOT, obviously, Texas stays warmer longer than Maine does, so the generators are aware of this. They're expecting that volatility to last into September, even October, so that outage and maintenance season isn't going to begin as early as it will up in PJM, New York, New England, but it will at some point, so that's what you're going to have to keep an eye out for, is how long that heat lasts going into September and October. And if it begins to start overlapping with when those generation outages come into place, that's when you can see that volatility kind of take a return, which would be a big change from what we've been seeing with this summer with real-time volatility really being stubborn and refusing to show up on a lot of days where we historically expected.
Yeah, I mean, when I think about that and, talking to your end user customers, and particularly people that might be on the fence, gas prices continue to stay low. It's been low. Winter right now, January of 19, we're looking at it. Is still right around that $3 range. Anytime there's going to be any volatility, much like we saw, this ERCOT heat wave, we see traders start to bid those up pretty fast. We start to see prices really rise quickly. As prices have stayed muted really through these heat waves, and again, those 4 major markets all got hit by heat waves, and really haven't seen any of that volatility in the short term, nor really on the forward curve strip. I like to think about this, and had I said this 10 plus years ago when I got into the industry, somebody would have slapped me for saying this, but that even though we're in July, it's not a bad time to be looking to take some of that risk off the table. I'm more worried about looking out at that longer term weather and saying, hey, there's potential that it's going to stay hotter than normal. Therefore, there could be additional cooling load going into some of these maintenance seasons where generation's coming offline, transmission's being worked on. And that's what I would be saying that's what worries me more. Again, 10 plus years ago when I first got into this, you'd be nuts to buy power in the summertime. That was high price point. You looked at those shoulders as the opportunity, but I think now with some of the different impacts that we're seeing, the effects of fracking, the change in the generation stack, my concern is a little bit more that fall period could be a little more volatile. And waiting till then to take risk off the table could be, I sound repetitive, but could be risky. I think it's a good opportunity to buy now. I would be looking to buy now. If I had some exposure out in July, like January, like Q1, Q2 of 2019, so customers that were unhedged, or if I was unhedged, I'd be looking at it as a good time to buy right now. I don't see any significant downside volatility. There's nothing that's going to come out and say push natural gas prices from like they're kind of that right around that $3 place down to down to 250, and therefore power prices are gonna kind of work in tangle with that. There is always that upside volatility. It's whether it's the physical grid breaking down or needing maintenance, or weather driving that. Again, I probably sound like a broken record from the last time we talked, but I see the risk to the upside, and I'd be looking to take any exposure I have off the table, and that's even looking out into 2019. If I can, out of the end of 2019. If I have a customer coming off contract next year, I'd be looking now to take that risk off the table. It's a good time to buy. Very little chance that prices are going to go lower or significantly lower, but there's always that chance that they could go higher. So I would be thinking, how can I get customers locked in, take that risk off the table, and let them focus on what they do best, right? Making their widgets or running their hotel or their restaurant, instead of worrying about what their potential energy spend is going to be. I think the last slide that we wanted to look at as we go to the next slide was kind of, we've been talking a lot about what's going on in Texas. This is our 12-month around-the-clock power strip, and you can see there's been some pretty significant volatility. When we look out, we started talking about this early this year. The reserve margin projections came out for this summer, and the market started to react, and it just started getting bid up and up and up and up and up. And then we got through that first kind of little bit of a heat wave in Texas in June, and the market didn't, the day-ahead and real-time market, there was really very little volatility. And so the kind of term traders looking out kind of started to lower their expectations, and we saw it really trade off. Well, leading up into this heat wave that we had the past week, you can see market traded way back up again. Joe was watching, some of the Val day. So in addition to being able to trade like, hey, next month, you can also trade what's the balance of the day. So say it's 10 a.m. in the morning, you're seeing heat come in. Joe was seeing Val day. What was it trading up to sometimes? Like
this past Monday, July 23rd, the trading for July 23rd that was occurring last week had put a value at about $850.
Yeah.
For just one of those days. But that was a couple of days out. Of course, when that day actually unfolded and we hit real time and prices came in the double digits rather than the thousands, the Val day traded all the way down from what started out as $850 all the way down to under $40. So you're getting those large swings just on the intraday trading. What we're seeing on the 12-month strip, although it looks incredibly volatile, which it is for a 12-month strip, the intraday volatility and even the short-term volatility is just incredible in comparison.
Yeah, and we've seen, we put this slide together yesterday, and even today that strip has fallen off even more. It seems like we're kind of back into that. You look at the last peak where it hit up to 60 and then dropped down. We're kind of in that same roller coaster ride back down. So again, this is where I start to say, if you have somebody with some exposure, it's not a bad time to take that off. You might not catch the very bottom of the market, but as you see, it's very clear on this. Those spikes are there. They are ready and waiting to occur, whether it's a weather forecast or some sort of generator system issue. Those spikes are there. So if you have a customer that's sitting on the fence, this is a great slide to show them. Like, look, that volatility is there. It doesn't take much to push it, and it's a good time to get locked in, get that off the table, so that we don't have to worry about you buying, $60 power, which is almost double what it historically has been in Texas. So with that, I think we'll dive into some questions. If any questions have come up from this so far, please get them in over the next few minutes. We did get a question about heat rates, and I think the first place to start is, what is a heat rate? A heat rate is it's a measure of efficiency for a power plant. You use a heat rate. It basically tells you, if I burn gas, how much power do I get out of it? And you use a heat rate for power pricing because you multiply what the heat rate is times the cost of natural gas, and that gives me what my dollar per kilowatt hour or my dollar per megawatt hour is. Every power plant has a different heat rate, and markets as a whole have a heat rate. The specific question was, everyone says heat rates are going to go up, and that is definitely something that gets talked about a lot. And where does that data come from? So Joe, I don't know if you
the way that I'm interpreting this question is like the heat rates have gone up, and I'm assuming down in Texas is where that's pertaining to. The way that the market heat rate is calculated, people just literally go and say, what is the price for power, and then what is the price for gas at the nearest hubs. Let's take Henry Hub, for example. Take the ERCOT North Hub divided by the Henry Hub price. Now, when you're looking at, and that's your heat rate, and when you're looking at what's happened in the last weekend on the forward curve, going back to that 12-month strip that we showed you in the previous slide, as that power price goes up, we'll think back to the forward month or the prompt month gas slide that we showed you very early on in the webinar. Those prices have remained stable. So you have power prices jumping up, but gas prices remaining the same. So you effectively have this quotient, which is with the numerator increasing and the denominator staying the same. That number, which is just, again, power divided by gas price, is going to increase just because the power prices are increasing. So when people say heat rates are going up, that's really just a reflection of the power prices increasing, whereas the gas prices are remaining stable. But that's the market view. As Elliot was saying, from an engineering heat rate for each power plant individually, their heat rates will typically, they'll remain the same. If anything, the heat rates will decrease if they add some efficiency technology to the power plant themselves, but typically a power plant will keep the same heat rate for its lifetime. And heat rates in general from an engineering side have been decreasing, I wouldn't say rapidly anymore, but with the influx of natural gas combined cycles, really all over the U.S., but especially up in the Northeast, close to the Marcellus area in Pennsylvania and New Jersey, all those new gas generators are operating off of a relatively low heat rate. And so in terms of the way that heat rates are trending technologically, they're decreasing. And that's just to say that technology is getting more efficient, generators are getting better, especially gas generators. But from a market perspective, and thinking back to that ERCOT run-up that we've had in the last half year or so, market heat rates are increasing. But that's really just saying power prices have jumped. It's not really a commentary on gas itself.
Yeah, another way to think about it is that, if heat rates are going up, gas prices are staying stable, effectively what's happening is less efficient generators are being asked to produce power, right? So we're getting into the less efficient generation stack. So these could be power plants that are mechanically less efficient, or also just don't run that often, and so therefore need to make their money when they do run. So they cost more to turn on. So we did see that heat rate, run up from the market perspective as a result of there being extremely high demand, and ERCOT, the ISO, dispatching less efficient generation to meet that demand. And oftentimes we see that happen more in the real-time market. We'll see that less efficient generation be dispatched in the real-time market as a reaction to we under-forecasted demand. What we saw this past week is we actually saw it being dispatched in the day-ahead market, and then it not being needed in the real-time market. And so therefore real-time prices were coming in significantly underneath where day-ahead prices were. It looks like at this point, that's the only question we have. We'll take give you guys a couple minutes to lob in any other questions you might have. Joe, anything else kind of on your mind to be thinking about over the next month before we jump on a call and talk again?
Kind of one thing to keep in mind. We did talk about now potentially being a good time to lock in those. If you do have risk on the table for the winter, lock that in. Kind of would maybe wait. See how the next couple of weeks unfold with ERCOT as the dust settles from this heat wave. There could be more for it to fall. It certainly has fallen a lot already in that 12-month strip that we did show you in the previous slide. Just on today with the refresh date, it's fallen considerably from where it's at in that chart. But there could be a little bit more room for it to fall, and then I'd expect it to kind of continue to trend downwards. That is until the next heat wave or the next batch of heat comes and the market over-responds again. But I would kind of wait for the dust to settle a little bit. It doesn't seem like a good idea to throw on hedges right in the middle of a heat wave or just after it's passed through. You might want to wait just for a couple of days to see how things come through. But that's really all I would have to add to that.
This is a great question. Probably will put a nice bow on everything that we've been rambling on about for the past half hour or so. Question is, overall, we see it as a good time to lock in rates, but don't see any big increases for electricity prices. And I think that's a pretty accurate statement. The way that I will caveat that, though, is there's always unforeseen things that I can't predict, that I don't see coming, that we don't see coming. And it's really a truism in electricity in general. You know, having been doing this for, the past 10 years or so, working with traders that have been doing this for 20 plus years, one of the truisms in electricity is volatility is to the upside. We're not going to see people produce electricity for free, right? There is a limited downside to this, but there is always the potential for upside volatility. If prices fit in with your customer's budget expectations, then I would say emphatically yes, it's a good time to be locking in prices. I will also say that there is nothing that I can see on the short to midterm horizon that would drive power prices higher. But again, that truism of volatility in electricity markets is always to the upside is something that I always want to caveat my thoughts on where rates are going to be and where they could be. And so yeah, I think it's a great time to buy. I don't think there's significant risk of spikes, but if it's a good time to buy now, I wouldn't see why you wouldn't want to. I don't see a lot of value in waiting at this point. Is really kind of my point of view. I don't know if Joe, you have anything to add to that?
No, that's I think that's a good summary of it, and I would just say, what this question was asked last month when we were talking. We were advocating for a similar thing, locking in those forward prices because they seemed lower. Gas at the time, if I remember correctly, was around $3.15 for January. Now it is all the way down to $3, traded under $3 for January. So yes, you could have saved a little bit by waiting a little bit, and maybe that would make your customer happy. But if you're looking at ERCOT, for example, at the time when we were talking most recently, ERCOT, that 12-month strip was in the $35 to $40 range, and we weren't certainly expecting it to run up all the way to 50 again, but it did. And so these unforeseen things can happen. If you were to ask the same question last month, we would have given you the same answer, and that would have avoided a lot of headaches and a lot of angry customers this month as the prices did run up, even though we didn't quite expect it. So to kind of summarize that thought, things will happen. No major expectation for it, but it can, and it often does. And I guess the question you have to ask yourself is, how do you want to position your customers? Do you want them to be prepared for that? Do you want them to be in the safety zone for when that does happen, if it does? And if it doesn't, maybe they end up paying a little bit more. What are they going to be most upset with And I guess that's the ultimate question.
Yeah, I think with that, we will thank everybody for their time. Always happy to answer any other questions. You can funnel those through a box and they'll reach out to us, and we're happy to answer any other questions. Looking to get through the summer, period and, into that fall period. We'll see if there's any more heat waves come along and how those impact prices. So Emily, with that, I think we'll turn things back over to you.
All right. I'd like to thank Elliot and Joe for sharing with us today and everyone for joining. If you have any questions at all that weren't answered, just email your account manager or broker support at brokeronlineexchange.com. Also, we'd love to hear any feedback or specific topics that you'd like to see our analysts cover next time, so please send those over to us as well. Thanks again, everyone, and we hope you join us next month.